Hey there, welcome everybody. We're just going to give it a few minutes. You are in the right place. You're at the 2-for-1 sale annuity life combo webinar. Your DMI team is here to support. Just letting everybody collect. Yeah, everybody, thanks for being here. I'm going to go ahead and jump in. But my name is Glenn Setchfield. I'm the Vice President of Marketing at DMI. For those of you that are unfamiliar with DMI, we're an IMO just south of Boston. And we've been in business for 35 years wholesaling life and annuity products. But we also offer our award-winning marketing services to financial professionals, and our back office and sales support are absolutely second to none. One of the best things about DMI is that we like to give white glove service to all agents. At the same time, we have the attention of all the major carriers and can really weigh in with them. Today's webinar is pretty unique in that we're going to hear from two industry experts that are DMI vice presidents. So you've probably seen Eric and Josh before. Eric Lendewall is our VP of Annuities, and Josh Rem is our VP of Life. Thanks for being here, you guys. Between the two of them, they've got over 60 years of combined financial experience, ranging from wealth management to annuities to legacy planning and so much more. I think Eric and Josh are going to discuss effective ways to deal with qualified monies when it comes time to take out RMDs. So not only will they cover the why of RMDs, but also the how, featuring some innovative products available through DMI. We've got Maureen Walker here as usual. She's DMI's content strategist, but today she's going to be monitoring your questions and polls. I just want to remind everybody that you should use the Q&A function to ask questions, and please participate in the polls and quizzes that Maureen has popping up here and there. Most importantly, there's a short survey when the webinar ends, and we would love your feedback. It'll help us tailor future events to what you really need, and that's why we're here for you. So with that being said, Josh, I know you wanted to talk about the agenda a little bit. Let me pop up our presentation today. And again, thank you so much for being here.
Cool.
And guests, thank you for being here. We really appreciate it.
Yep. Yeah, definitely. Thank you for being here today. Thank you for taking time out of your schedule, depending on where you are, morning or afternoon or lunchtime. Thanks for being here today. We'll make it a good use of your time. Here's a brief overview of the agenda. We won't keep you for too long, but we'll hit on some very important, concise points. The opportunity, the old way versus the new way, or really just making sure we deliver the right solutions that are relevant to today and what your clients need. We'll go through a couple of case studies and, of course, some conversation starters and discovery questions that can help you identify the business and have these conversations. They'll conclude from there. So if we go to the next slide, Glenn. Cool. So present the right solution. So I was thinking yesterday, Glenn was actually bragging about a fishing trip where he caught a ton of fish, a lot of fish, which hurt my heart because I went fishing recently and didn't catch anything. But Glenn caught, yeah, that's all right. Yeah, he said he caught so much fish, it just messed up the whole ecosystem for where he was at. So tremendous success with fishing. Surely some of that had to do with the fact that he was probably using the right bait and the right lures. So marine loss being one corny analogy per webinar. So hopefully you see this connection. In large part, your success will have to do with presenting the right solutions, giving the solutions that your clients want to hear. And that, like Glenn's fishing trip, will make you more successful if you're presenting the right solutions. And today, when we talk about presenting the right solutions, what we're solving for is two things. A tax-efficient way to leave a legacy and then also preserving assets by means of having some type of resource for paying for long-term care. So your assets are depleted. And there's a right way to do it. You want to deliver the right solutions. There's a lot of changes to tax laws that are quote unquote sunsetting, that are reducing the amount of deductions that people can enjoy before they have to pay estate taxes. Now, a small percentage of your clients may be affected by that, but that doesn't mean that your client's legacy won't be taxed, because in large part, your client's wealth is probably in retirement accounts. So we want to make sure we have strategies to be able to transfer that wealth in a tax efficient way. And we can do that through an annuity life combo in a very effective way and create two sales for yourself. Another way that we want to deliver the right solution is this solution, an annuity life combo. It's not a new idea, but oftentimes what's been used on the annuity side is a SPIA, a single premium annuity, immediate annuity. But today we have award-winning products to where you can have an annuity that can create a meaningful source of income, but while still maintaining control of the asset and making a more meaningful use of it. So we'll talk about how we can use that. We'll apply that to some case studies and examples, and we're going to use strategies that can reduce taxes, maximize the death benefit, and preserve assets, both your clients and the assets that you manage, by using a long-term care strategy. All right, so that's what we're looking to do. With that, I'll kick it off to Eric to describe the first case study, and then we'll talk about the solutions.
Great. Thanks, Josh. And good morning or afternoon to everybody. Thank you for joining us. And some of you may realize this is the third in a series of webinars that we've been putting on to talk about ways to be creative with respect to folks' qualified money. So for today, we're going to talk about two case studies. And the first one is John and Mary. So I'd like you to think about the clients you work with when I walk through John and Mary, because they're probably going to sound a lot like some of your clients. So John and Mary are in their late 60s. They're both doing great from a health standpoint. Got a couple of grown children and 3.5 grandkids. So I don't know how you have a half a grandkid, but on average, that's typically what they have. They need about $7,500 a month for income and retirement. Here's the great news. They're doing fine from an income standpoint. So they're not the folks that are transitioning into retirement and trying to figure out how are we going to connect the income dots between Social Security, pension, and some rental income that they have. They're doing just fine. They've accumulated some assets. John's got an IRA of about 250 grand. Mary actually did a little bit better. She's got about $320,000. They've got some money put aside in non-qualified assets from an inheritance, and their rental property's worth about $450K. So at face value, John and Mary have it made, right? So when they think about their retirement income, their retirement assets, they're not necessarily concerned about driving more income out of that qualified money. So for a lot of folks, they may be just that simple, I'm going to take RMD type person, right? And we talked about a solution for that 2 webinars ago. But no, John and Mary, really have some concerns about legacy for both their kids and grandkids, and they really want to do the best they can with their qualified assets, or a portion of their qualified assets, to create a nice tax-free legacy for the next generations. So, working, thankfully, their advisor works with Josh and I here at DMI, and they put together a solution that's going to make a ton of sense. And that solution is transitioning some cash flow from their qualified plans into an indexed universal life policy. So let's walk through what this looks like. I'm going to talk about the annuity side and then turn it back to Josh for the life insurance side. So step 1 is to move John's $250,000 qualified account into a guaranteed lifetime income solution, such as the Athene Ascent Pro 10 bonus indexed annuity. So we're going to look at a couple of slides here, but the nice thing about this particular solution is it creates a high level of guaranteed joint life income for John and Mary. In fact, that $250,000 would create an immediate income of $17,000 a year guaranteed for both lives. Now, what John and Mary are going to do is take that distribution, and because it's qualified money, pay taxes on it. And they're going to be left with about $15,000. By the way, $15,000 of income per year that they don't need. And they're going to use that to fund an IUL policy. We can go to the next slide, Glenn.
All right. Yeah. So good. And I'm thinking, Eric, that 3.5, that 0.5 grandchild, I'm thinking they got one on the way. So
I think that's a great point. You had 2 cups of coffee this morning. I only had 1.
That's my guess. I don't know for sure, but that's what I'm thinking. That's what I'm hoping is the case.
Right.
So yeah. So they have an IRA they don't need, and they have money they don't need. So of course they could say, hey, we're just going to take it out of the IRA and give the kids now, but that would create a tremendous tax burden. Probably put the grandparents in a new tax bracket. Not efficient. So again, Eric provides a solution that can give them a guaranteed source of income. So we're going to take that source of income, and then what are we going to do for it? So what are we solving for? So know that myself and Eric are always here to give you illustrations for your clients as you ask for them, as you need them. But understand, when you come to us asking for an illustration, we certainly will want some information about your client. What are they trying to solve for? So that you can go and present the right solution. So as we've established the case study, you have grandparents who don't need the money and they want to leave a legacy to their children. So based on that objective, here's what we would suggest. We got the annuity, now here's what we would suggest on the life side. So we take that lifetime income and we're going to put it in a guaranteed universal life policy. Now, how do we design the policy? Again, that again depends on what we're trying to solve for. So when it comes to a legacy, a couple things. Number one, we want it to be there for them in the event that they pass away. So this particular policy is guaranteed at least to age 100. And we can stay on that. We can stay on the other page for a moment, Glenn. I think you got to go forward. Yeah, we can stay here for go back. We'll stay there. Stay where we're at for just a second. We're getting there. There you go. Thanks. There it is. Yeah. So again, we're designing it, first of all, to be in place till age 100. Now you can design these products with some flexibility. We want it to be there for them if and when they should pass away. This is guaranteed to age 100, and with any help from the performance of the underlying cash value beyond that. So guaranteed to age 100, that's how it's designed. And then of course, when it comes to cash value, it will be there, but that's not our concern. So we don't want you to go to the client presenting the cash value. It's there, but that's not what this is designed for. We're designing it for a strong cash value, a strong death benefit. So now with that, a second to die or a survivorship policy makes a lot of sense. Why? Because in any case, the estate will typically be passed to the children after both the mother and the father, and in this case, the grandmother and the grandfather, pass away. That's when it's going to pass to the heirs anyways. So a second to die policy makes sense. And a second to die policy is much more expensive in terms of premium, and it can leverage a much higher death benefit as opposed to going out to buying one on each. So that's the reason behind this. So we have a second to die policy guaranteed to 100, designed to maximize the death benefit, to maximize the legacy. So would you say that would meet the objective of what your clients told you you're trying to solve for? I would say so. We've designed a policy based on the solution. We got the right lure, got the right bait. We're giving the clients what they want in order to increase our chances of them moving forward on what they need. All right. So that's how the policy is set up. So if you go to the next page, we'll look at some of its features. Back. There you go. Next. Nice. Okay, so again, we see some accumulated value, cash values there. Don't spend a lot of time on that. That's not the purpose. Can go back to that page. Go ahead. All right, right there. Perfect. So now, if we're assessing the performance of a policy or a product, in this case, the life insurance, how good of an investment it is relative to what we need it for. So we need it for the death benefit. So the death benefit from day one is $723,492 for that annual premium outlay of $15,000, which, by the way, is the income they don't need. The income they don't need is going to give them an immediate death benefit of $723,000. So if they were to die today, God forbid, and that happens sometimes, sadly, then of course the internal rate of return as it relates to the death benefit is astronomical, the 4,000% rate of return. However, even as you go down through the years, the internal rate of return at age 88 would be 7.3% as it stands, just standalone 7.03%. Even at 93, 4.73%. If they make it to 100, if they both make it to 100, God bless them. The rate of return comes down 2.37%. But congratulations for making it to 100, and still it's worth it. But then we look at it from a tax-free standpoint, because now you're creating a tax-free legacy for your children. So a tax equivalent rate of return. For them to pass away at 88, you would have had to get a 9.373 rate of return year over year in order to invest that somewhere else and generate a death benefit that you would get from this life insurance policy tax-free. So based on what we're trying to solve for, you can't really beat life insurance. Of course, there is some health concerns there, and we can talk afterwards too. I ran this, can't find my note, but I ran this where they were even at a table 2. So there were some health concerns. The death benefit came down to maybe 500 and change. So there's still some little room there if there's some health concerns. So this solves beautifully to give their heirs a large death benefit. From a tax-free rate of return standpoint, you can't find this anywhere else. You can't invest on your own. It puts to use assets that they don't even need from a IRA standpoint.
Josh, can I jump in here for 1 sec?
Please do.
There's a question that popped up. Someone's asking, can a second to die be issued on any 2 people, or do they have to be a married couple?
So we traditionally see this on married couples. Some carriers will allow it. I guess it would depend on the circumstance. If you can make a case for the insurable interest and a reason behind it, that would make sense. Sometimes it's not just a husband and wife. Talk to me offline and see if you have an actual case or what that scenario might be. The short answer is yes, depending on the circumstances and why you'd want to do that.
Right.
Good question. Great question. All right. So we have all of this, but like I alluded to before, we didn't use a single premium immediate annuity. We didn't just get rid of the asset. So if I'm not mistaken, Eric, even as they're paying these premiums from that annuity, there's still some stuff going on in the annuity.
That's right. That's right. So Glenn, if we can advance 1 slide. Perfect. Yeah. So, I could, before I dive into the numbers, I could stop and just describe this scenario very simply. We took a $250,000 qualified asset and we turned it into, on a contractually guaranteed basis, $723,000 tax-free to the heirs at death. That's a really powerful story, right? And quite frankly, that will be the story if the annuity, A, never earns a penny ever, and B, the clients live long enough. Everybody here has seen annuity illustrations on the 0% return page where if you live long enough and you're taking out your guaranteed income, you eventually drive the accumulated value to 0. We don't want that to happen, but quite frankly, we have no control about how the markets will do in the future. However, the great thing about the quality index annuity solutions that we represent here at DMI, and the Ascent Pro 10 bonus is certainly one of them, one of the leading ones, is there's innovative index options with extraordinarily high, in fact, historically high participation rates currently. So in the background, as these lifetime income withdrawals are coming out each and every year, guaranteed not for 1, but 2 lives, the index options give the client the opportunity to receive credited interest on their market value. So this particular slide is showing the most recent 10 years of back-tested index performance with current participation rates applied. What does all that mean? The income remains steady. The life insurance premium gets paid. The tax-free death benefit will happen. However, the client is still going to have, in this particular scenario, a significant death benefit that will go to the heirs as well. So based on this, if both insureds pass at age 85, there's still going to be $324,000 left in this qualified annuity that would be paid out in the form of a death benefit. If they live to 90, with this particular performance scenario, there'd still be $300,000. So now we took that 250 and not only created that 723 of tax-free death benefit, but there'd still be an additional 308 to go to the kids or grandkids even at age 90. Now, fair disclosure, is this guaranteed? No. We don't know what future performance will be. But the reality is the truth will probably lie somewhere between the 0% return scenario page on an illustration and the back-tested return page. So if we were doing it just for the life insurance, it's an absolute home run solution. In practical terms, with performance on the annuity, it's a grand slam.
Yep.
So we can move forward a slide, Glenn. So when we talk about performance, we like to look at, hey, what if my timing's really good or not great? But there's a lot of different performance metrics that you can measure. This particular solution, the worst it did over a 10-year period within the last 20 was net of charges 5%. In fact, the highest upwards of 9%. So, we don't like to forecast future performance, but just rest assured that this is a solution that your client's going to drive a lot of value out of. So with that, I think we can move forward another one. Glenn? So
Yeah,
really to recap, we took John and Mary, who were very, very typical clients. They were lucky enough to have their income squared away in retirement. They had some qualified assets, and they had a whole lot of love for their family. And they just wanted to take care of their family. Their default option, and Josh, you and I see this all the time working with the agents and advisors we work with. We have the opportunity to speak about dozens and dozens of client situations each and every week. The default go-to approach is just take RMDs. Try to minimize the withdrawals from the IRA so we can maintain that balance for the heirs. Folks, there is a better way. There is a better way. And the way to uncover it is to work with Josh and I here at DMI. We're going to ask you a lot of hard questions about your clients and what they're trying to accomplish. And oftentimes we can come up with a pretty straightforward, innovative solution to create better outcomes for clients. Because at the end of the day, that's what we're trying to help you all do. So with that, let's slide forward to our next case study. Oh, Maureen.
If I could just ask a couple of questions from the field.
Please do.
Josh, what is the life insurance product that you were talking about?
Yeah, that's a good one. That's a second to die product from Principal, but there are other carriers, and we're not exclusive to one carrier. So on a case by case basis, we'll present what's best based on the clients needing across the table from us.
Excellent. And Eric, how much is the bonus right now on the Athena Sen?
So you've got a bonus on the income base, and then you've got a bonus on, there's actually a small premium bonus. So it varies a little bit in the state, but figure 20% and 3% respectively.
Thank you.
You're welcome. Okay, so we're going to dive into the next case study. So this is a little different in terms of what your normal client situation might be, but certainly we still probably run into this quite often. So we're going to talk about Roger Thompson. Roger, unfortunately, at 65 years of age, finds himself a widower. He's got a grown child, and Roger loves to work. In fact, he's not even thinking about retirement. He's working part-time and doesn't know when or if he'll ever fully retire. In fact, he's deferring his Social Security at age 70. Things are going okay for Roger. He's got a good IRA account. He's got some equity that he recently came into because he downsized his home, and he's got some money in a non-qualified brokerage. When you talk about retirement or the next stage of life with Roger, what really comes to focus is he's not worried too much about income and retirement. His biggest concern is as he gets older and might need care, who's going to take care of him? Will he be a burden? He doesn't want to be a burden to his kids. So how do we plan for and solve for that? And the solution here is to really try to leverage his qualified money to take care of that problem. An IRA to LTCI solution. So we can go ahead and advance. Now, typically, like Josh said before, oftentimes a funding vehicle, when an annuity is used as a funding vehicle for an insurance product, for years, the industry would put it in a SPIA, a single premium immediate annuity, with a period certain option. And that period certain payout option would mirror the premium responsibility for the insurance product. Here, what we're doing is we're using an indexed annuity that has an income rider embedded in the product, but we're kind of doing things a little bit different. We're using the Athene Agility 10 indexed annuity. Now, what's unique about this product? Well, first of all, it does have a no-fee embedded guaranteed lifetime income rider, but there's a caveat. You can't turn that income rider on until the end of the 10-year surrender charge period. So we're going to look at a couple of slides here. This first one is assuming you'll notice absolutely no performance of any kind ever. The liquidity is 10% of initial premium. So what we're doing is we're stripping out, let's go back one for a second, we're stripping out $25,000 each year for 10 years. Now, math is not my strong point. Just kidding, it is. But if it wasn't, if I've got 250 grand and I pay no fees and I make no interest, if I withdraw 25 grand a year, I'm going to be out of money in 10 years. And in this scenario, that happened, right? So we stripped out 25 grand a year to be able to fund an insurance product to take care of Roger's concern about long-term care. Now, again, we don't believe that the markets will do nothing from now until the end of time. So let's look at what this solution might do on the annuity side if there's performance. Okay, so same exact product. Same exact 10-year run on the $25,000 partial withdrawals that's being used to fund the insurance product. Here's what's great about this particular solution. You can strip out all of those free withdrawals for 10 years. And at the end of that 10-year period, if there's been performance in the product, there's going to be A, money, and B, an income base or a benefit base left in the product. So what did Roger do here? He stripped out $25,000 a year to fund an LTCI solution. And then he turned on guaranteed lifetime income. So Roger, for 10 years, funds his LTCI solution. And then in this particular scenario, was able to trigger guaranteed lifetime income payments beginning at age 76. And you'll notice that column, they have the opportunity to increase as there is performance in the product. So again, this is not guaranteed, but we believe that the truth probably lies somewhere between 0 and what you see here on this page. So again, had that qualified account, didn't necessarily need income right away, wanted to leverage it to solve for a problem that was really worrying him. And so we've created the income stream, we've created the funding for a solution that Josh is going to take over and walk us through.
Yeah, and we can go to the next slide. And again, so why, next slide again.
Yeah, go ahead.
There we go. So again, so why do this in the first place? I mean, we're seeing these cases pretty regularly. I just did a pretty large case where a lady had a substantial 401k, didn't need it. Single lady, and was worried about her care not being a burden to her kids. So instead of obviously withdrawing a large portion of the 401k and creating a taxable event, put it in the annuity, creates a sale for you, and then we can exercise the free withdrawals and spread those taxes out and use it for long-term care premium. Long-term care premium, consider long-term care asset protection, because you will blow through assets very quickly. With the cost of long-term care, you'll blow through it very quickly if there is no plan in place. You'll blow through your own assets, you'll blow through the assets that you would have liked to have preserved for your heirs. So this makes a lot of sense. These two scenarios are something you'll probably see more frequently. All right, so We're taking those free withdrawals. Again, worst case scenario, if nothing else happens in the annuity, we have those free withdrawals to use towards this. So how does this work? So we're going to use a asset-based long-term care product, which is a hybrid, in other words, between a life insurance product and a long-term care product that focuses not so much on the death benefit, but maximizing long-term care. Now, how it works, I think, Eric, what do you say? People want to know how the watch works. They want to know what time it is. Is that how it
Yeah,
goes?
most people don't want to know how the watch works. You just got to tell them what time it is.
You got to tell them what time it is. So we're not going to spend a lot of time on this. On this slide, on a one-on-one conversation, I'll educate you so you feel confident in explaining it to people should they want to know how the watch works, but most people don't. They want to know how is this going to help me. So your premium, in essence, will create an accelerated death benefit. It will create a death benefit that you can accelerate. And then it will also buy a 4-year extension of benefits to multiply that figure for long-term care needs. We're going to leave it as simple as that. It buys a death benefit, and then a rider will multiply that death benefit that will correspond to the amount of years you want that long-term care to last. All right? And it's a great product. So we'll leave it at that for now. Let's go to the next slide. Okay. Now, the old way, traditional long-term care products, and there's not a whole lot of them, but they are still there, is it's a use it or lose it play for traditional long-term care. You pay a significant premium. By the way, traditional long-term care products, those premiums are not guaranteed. They can and tend to go up over the years. In this product, the premiums will be level and will never change. And then also, if you should die before you need the care, there's a death benefit built in. If at some point down the road, you should decide, hey, for whatever reason, I just don't really think I need this anymore, then you can get a good portion of your premium back as you go along. So all that is to say, we have a solution that is not a use it or lose it benefit, which is something that has resonated a lot with our clients that we work with. All right, next slide.
Hey, Josh, can I jump in for one sec? Had a question pop up here. I think I know the answer, but I want to defer to you. So the question was, can we use IRA dollars for a hybrid such as this? And in this particular solution, we were taking the $25,000 out, paying taxes, and creating, I think it was somewhere in the neighborhood of 19 or 19.5 for the scheduled payment. Is that generally the approach you take when structuring these with qualified dollars? Pay the freight first and use what's left for the premium?
Yeah, and so qualified dollars, that's exactly what we're speaking to right now. Because again, a lot of your clients' wealth may be in qualified dollars. But at the same time, they might not need all of that to achieve their income objectives or to achieve other objectives. So really, you're going to be left with, and we call it finding the money. Oftentimes that money is going to be found in qualified accounts.
Right.
So the answer is yes, you can use IRA dollars, but this is how you do it. But instead of taking it all out at once, because you can do a single premium into these, that works. But instead, put it in an annuity like the one we have. And I'll have Eric return to the idea that you're still going to get some value out of this with some performance of the annuity. But yes, use IRA dollars the way we're telling you to do it today. Okay.
Great, thanks.
Yep. So we're going to take that free withdrawal of $25,000, and the after-tax premium would be about $19,500, and we're going to do it in a 10-pay. So again, from year one, from a monthly benefit standpoint, that would immediately generate about $6,700 in a monthly benefit. Not bad, and a total benefit of $525,000. So you're taking $195,000 over 10 years of premium payments and immediately generating $500,000 in a long-term care benefit, in a pool of long-term care benefits. But we're going to apply a 3% compound interest to this, to where once you get to, say, 80 years old, at an age where you become more likely to need that type of care, then that monthly benefit grows to $10,540 per month. And you have this pool of $818,000 to spend on your long-term care, having spent $195,000. Okay. And from an internal rate of return standpoint, as some people say, well, I'll just invest that $19,000 elsewhere. Well, you can do that, but hopefully you can find a product that will give you a 10.93% rate of return every single year. I don't know if something that can do that. If somebody says they have a product that can do that, would run the other way, because I don't think it exists, at least not on an honest, legitimate way. All right. So, see, Maureen, you got a question?
We do. Thank you, Josh. It looks like the death benefit increases, and how is that accounted for? Is the death benefit plus accumulation value? Is it the death benefit?
Yeah. So what we want the death benefit to ultimately achieve is at least a return of premium, right? So it is increasing, and it stays pretty much level up until year 9. But then after year 10, the death benefit will at least be a return of premium, right? So the death benefit is not the focus, but it's there. So for instance, in year 1, you would have paid $19,500, but got $162,000 death benefit. Could have got a much larger death benefit in a regular life insurance policy. What the death benefit is designed to do is at least to get you to a point where you'll get a return of premium after the 10th year of a 10-day. All right. Does that answer the question, more or less?
I would guess.
All right. So this is the benefits. Let's go to the next slide. So here's just another thought on self-insuring. That might be one of the, let's stick on that slide for a minute. That might be one of the objections you get. But as we talked about from a rate of return standpoint, you can't truly self-insure. So $195,000, you'll blow through that so quickly. If you need a long-term care, if you have a long-term care need, and then from there, where do you turn to? You turn to other assets, and then before you know it, your assets are depleted. So try to abandon the idea of self-insuring that I can pay for it on my own. Instead, self-assure and use that capital to generate a much larger pool of long-term care. All right, next slide. Okay, so we use a number of products. One product that we find resonates well with clients are those that are cash indemnity products, which means once you qualify the long-term care, that benefit that you receive is just a check. You don't need to show receipts from a facility. You don't need to show receipts for care. That is money that you can use to get the care as you see fit. So what that means is a lot of people, they don't want to think of nursing homes. They may want to think of being at home and receiving the care that they need in the most dignified way possible for as long as possible. So you get a check and you can use it to maintain your quality of life, even in a moment where you need long-term care. Use it for anything. Once you qualify for the long-term care benefit, you get the cash. Now, one other last feature that's really great in attracting interest is we're all familiar with a elimination period. So elimination period is the amount of time that you have to pay out of pocket before the benefit kicks in. In this case, it's 90 days. But what's interesting is with Nationwide, they will pay that elimination period retroactively. So after you wait out that 3 months, in the 4th month, they'll pay you that month's benefit payment plus the 3 months benefits that you waited on. So at age 80, your benefit was $10,540. So you qualify, but you got to wait the 3 months. But in that 4th month, after you wait out the elimination period, that first benefit check is $42,160. So how beneficial will that be to somebody who needs a long-term care and wants to pay for it for the support they need to support the lifestyle that they want, even in that scenario? So again, a tremendous way to leverage assets. And again, Eric, if you can say again, even as we do this, there's still benefit that can be had from the annuity as we're spending this money.
Yeah, and that's the bottom line is we don't want to just make this this qualified asset just go away, right? But in the situation with Roger, he wasn't relying on it for daily expense and annual expense income, right? And again, Roger's default position, had he not worked with an advisor that was creative and looked for innovative solutions, would have been just to take RMDs. And I call it the RMD and hope strategy, right? He would have taken RMDs and hoped that when he had a care event, what was left in his IRA would cover him. Some people call it the hurry up and die approach, right? So, we're leveraging his qualified account. to be able to put in an innovative solution like this into effect for him. And after the premiums are done, there's a very real likelihood that he's going to be able to hit an income switch on that annuity and continue to receive income. So why don't we, Glenn, go ahead and flip to another slide here. And so that's really what we did. You know, we took Roger's pretty standard normal situation, the before situation, and we did a few things. We reallocated some assets. We protected him from market risk on that particular piece of his IRA. We created an after-tax income stream to be able to fund the exact solution he needed to give him peace of mind, knowing that in his time of need, later in retirement, he was going to have the funds needed to take care of his care and not be a burden on those that he loves. So again, did we sell a product here? No. I mean, the solutions that we utilized were just that. There were solutions or tools that a skilled practitioner used to solve a client's problem, right? Nobody cares about how the watch works. They want to know what time it is. For Roger, what time it was, I'm worried about long-term care. Help me fix it. Yeah. Maureen, every time you pop up, I know you're going to ask a very challenging question.
I see some good questions in the chat.
Yeah, there's a really great question, actually, that I haven't thought of, but I'm sure you folks have. If people want LTC services, but they move overseas, how does that work? Can they still obtain their benefits?
Yeah, so oftentimes a portion of the benefits may be available for overseas care, and we can match the right carrier for that. But it's typically not going to be the full benefit overseas. Okay. And could I address the other questions in the chat?
Please do.
Yeah. So somebody mentioned the cost of long-term care today. It is a lot. So either you have a client who can build a policy and has the money to address the full need. This is just a case study. So in Alabama, somebody said it's 40 to 50K a year, nursing home in the 100K range. We know that. So if they have the means to build a policy for that, that will address all of that, great. Even if they can knock out a portion of that, that's good too. And we'll design the case according to your client's needs. Somebody also said, what's the average stay? 2 to 3 years, typically. So if your client is good with that average, build a case for a 3-year benefit period. If somebody thinks they'll live longer, you can do a 6-year benefit period. If somebody wants to know that it'll be there for the rest of their life, we have policies that do lifetime benefit periods. So we have these case studies, but please come to us with specific questions and specific cases, because we can design it according to your client's needs. Right.
Thanks, Josh. So let's wrap it up. You know, like I mentioned at the top, today's webinar is the third in a 3-part series talking about ways to be creative with qualified money. You know, we started off with the Athene BCA with FER Legacy Rider, which was an annuity solution that, folks, is absolutely innovative. It's one of one. It's a unicorn, and it's helping agents and advisors close large cases. Then we transitioned to the second of our webinar series, which talked about ways in which you can satisfy one's RMD requirements utilizing less of their overall capital. And for those of you that might be doing assets under management, that's important because it relieved pressure on the rest of the portfolio to have to handle distributions. And then finally, we wanted to end with this 2-for-1 solution because it's really focused on 2 client situations, so 2 client problems that, quite frankly, Josh and I run into each and every day. Now, we went over a lot today, and we don't expect you all to remember it all. And quite frankly, glad you don't, because that's why Josh and I have jobs. But what we really want you to take away from today's event, and really all 3 events, is let's not fall into the old habits of taking the old approaches to solve client problems. In my opinion, every single client deserves a fresh, innovative approach, a fresh set of eyes on their situation. And when you work with Josh and I, we're going to ask you tough questions. We're going to ask you a lot of questions. But at the end of the day, it's so that when you get to point of sale with your clients, you have a properly vetted, innovative, and effective solution to be able to solve their problems. Josh, anything to add?
No, that's great. Like I said, we want to give you the right tools to work with the clients and then to address the solutions that you need. So we're here for you. Again, come to us with questions about this webinar or anything else. But we appreciate the time you spent with us today and you want to work with it.
Thank you.
Thanks so much, guys. Fantastic work. And I just want to remind everybody that, if there is something that you want to review regarding this presentation, we're going to send those recordings to you in the next 48 hours or so. But then also always remember, we archive this material on DMI University, and DMI University, per Eric's comments, offers a lot of real creative solutions around things like RMDs, leaving a legacy, and a lot of other topics that can help you with your business. So check that out. Look for the archive section, and then give Eric or Josh a call on any needs you have. They're always happy to help. Maureen, did we get all the questions? I'm seeing a couple questions still up there, but
I believe we have the majority answered, Glenn. And, as always, we encourage everyone to reach out to either their primary vice president at DMI with questions. You can always reference this webinar, or reach out directly to Josh and Eric.
there you go. Hey, and Maureen, are there any webinars coming up that we should tell the crew about here?
We have a great webinar coming up in June on webinars. I know that sounds a little confusing and a little misnomer.
Well,
but
we have
A webinar on webinars.
a webinar on webinars. We're going to feature our new DMI webinar and workshop process and how we can help you with this. It's a lead generating machine.
It is, absolutely. Yep. So I saw some people that were interested in marketing in some of the surveys, so they may want to check that out. So yeah, I appreciate everybody's time. We attendees, we really appreciate you being here. Josh, Eric, excellent job. Maureen, excellent. Thank you so much. You guys have a great rest of your Wednesday, okay?
Thanks, guys. Thanks, everybody.
Thank
Take
you.
care.
Have a nice day.